For today's conversation, we are delighted to have with us our global expert in the digital companies who will be joining us virtually. Ladies and gentlemen, before we present him, would like to give a small introduction. The one who's going to address all of you with official welcome note, our keynote speaker, is someone who has been at the forefront of understanding, analyzing, and shaping the global health tech ecosystem. Joining us virtually is Mr. Dario Heymann, co-founder and chief technology officer of Galen Growth, an organization building one intelligent platforms. Dario led the development of HealthTech Alpha, a platform tracking over 70,000 digital health companies and nearly 2 billion data points, enabling AI-powered insights that help healthcare systems and corporations make strategic, smarter decisions. Under his leadership, Galen Growth achieved profitability from its very first year and has delivered over 150 strategic projects from leading pharmaceutical, insurance, medical device, and government organizations globally. His expertise spans digital health, intelligence, health tech strategy, AI in healthcare, sovereign AI, and venture intelligence. With a background that brings together science, technology, academia, and the pharmaceutical industry, Dario offers a truly global perspective on where healthcare is headed and what it will take to turn data and innovation into a meaningful impact. So as we begin our conversation today, ladies and gentlemen, on the future of healthcare innovation, we could not ask for a better person to set the context. So once again, please put your hands together, everybody, as we have with us Mr. Dario Heymann, who will be joining us virtually. All the eyes on the LED, and can we have him on board? Over to you, Dario. All right, so we'll take a minute over here to connect with him virtually. So we are working on the technical side. We'll be having Mr. Dario Heymann, co-founder and chief technology officer of Galen Growth, joining us virtually very shortly. Yes, Dario, you're audible. You can start.
Hi. Hello, everybody. A very good morning. And thank you so much for the introduction. It's truly an honor to join, despite virtually. I have a 3-month-old daughter at home, so it was a bit challenging to travel all the way from Singapore over to the event. But thank you so much for the HealthTech team for putting the event together and for having me give a little keynote to start your event today. I put this presentation together to help you understand a bit more about the Asia Pacific region, how it is comparing globally, and some of the learning points that we've seen from a Galen Growth point of view that end up in different places. We take India as a comparison overall. It has built more digital health companies than anyone in Asia Pacific, except probably China. Japan and Korea, on the other side, built the third as many, but are twice as mature in terms of where the companies are. And today I'm going to focus a bit on what are some of the key reasons behind that, what happens when capital starts to paying for the second thing overall. As for some housekeeping point of view, all of the data that I'm representing is as per last week Friday. So you see almost the latest and greatest of data that we currently have within the system. When we speak about digital health overall, we've entered into a very selective recovery run overall. 4 numbers that are standing out here. So there are about 16,500 digital health ventures that are active. There are about 70,000 companies that are active within the digital health space, but that covers everything from digital health startups, so everything that is born after the year 2002, as well as hospitals, pharmaceuticals, insurance companies, CVCs, VCs, PE firms, and everyone around it who is involved in the innovation in digital health overall. This year to date, we've seen $20.3 billion being invested in digital health. About 580 funding rounds, out of which the majority of them are disclosed. When we look into the run rate overall, and that means where do we expect the funding to close by the end of this year? So we're probably at around $36.5 billion. And this is compared to $33.6 billion that we saw at the end of last year. So it seems that capital overall is back. But when we look into the history of the past 6 years of where digital health was, we're still running around as half of the 2021 peak, which goes at $73 billion. Now, this was the onset of COVID. Everyone was pouring into digital solutions, considering that they were thinking that this might be the holy grail as to what it was before it really started plummeting down between the years 22 and 23. In 24 and 25, we've seen a slight recovery, but the recovery is not the same boom that we've seen previously. When we compare this to where the funding probably was, the 36.5 that we're expecting now brings us roughly back to the same values that we've seen back in 2019, so about 2 years prior to the major boom. So the important part is what the recovery actually reports. So I'm going to focus a bit deeper on some of the categories and some of the infrastructure that we are seeing. So research and diagnostic infrastructure actually making up 44% of the global funding at the moment. And the markets have deeper buyer ecosystems. So when we look into the US, it actually represents 53% of the global funding alone at the moment, which is quite significant because it has been creeping up year on year to really reach a number that now represents more than 50%. And a higher bar for scale is the evidence embedding of the workflows in the enterprise distribution that we actually see, so that a company can actually reach its reach. And the concentrations decide of who actually gets funding within the cycle overall. So when we look back into on a geographical spread from a category point of view, what I was just mentioning, 53%, which represents about $10.7 billion, have been invested thus far into the US this year to digital health. Adding the UK, South Korea, Hong Kong, and France, the top 5 markets in terms of funding actually make up 82% of the global capital that has been invested. Even China this year has been extremely bad. Now it's still more than what we've seen within India, but it's well behind countries like France and South Korea. We look into where India sits, and I'm going to deep dive a bit on this in a couple of slides from now. The gap is there and is going to be the whole argument of this talk that I'm giving at the moment. We look into where funding is floating into. 6.56 billion actually is floating into research solutions alone at the moment. If we add medical diagnostics, which are 2 very evidence-heavy categories, account for about 44% of all global funding. Now, this has a reason. Considering that most solutions at the moment are looking into implementation rather than just yet another B2C solution, and a clear path to affordability and to making an impact on some of the research pipelines that we are seeing. So diagnostics, everything from your digital pathology solution all the way over to your lab on a chip solutions, is really making a comeback and has been, as we've seen for the past 2 or 3 years. So the capital is moving towards platforms that actually can create this proprietary evidence and help improve clinical decisions, are becoming an embedded infrastructure overall. So when we now look into where these $260 million in India are floating into and how does this compare as compared to the previous years, I kind of try to focus a bit more on this now. So when we look into where the capital flow of India is currently floating into, it's not really against its global cycle, but it moves with it. There's a bit of more amplitude in terms of both directions, either up or down. When we look into where we were in 2021, which has been the peak of your online marketplaces, 1mgs, PharmEasy's, and so on, India actually represented about 3.5% of all funding that was deployed on a global scale, which is actually quite a lot when we take that there are more than 200 countries in the world out there where digital solutions can actually happen. This number has plummeted to about 1% in 2025, before now recovering to 1.3% as of now, this year in 2026. So we see a slight recovery, but the asymmetry here is the point that while the global funding actually rebounds, that's back in 25, it fell further in India by about 60% as compared to the previous year. And now we are slowly but steadily starting to see a recovery, which is majorly driven by some of the funds now closing and starting to deploy funding again. And we should see this as that there's an opportunity for some of the established companies to further scale into the evidence-led enterprise-grade growth that we are seeing. And we actually take an investor point of view from where the numbers are coming from. Back in 2021, it's a number that is not really on the slide visible, but there were about 250 investors that were actively deploying capital in the Indian market. Now, this is not just your Indian CVCs and VC firms or PE firms, but also global international companies that are betting on the very large market. Now, in 2025, this number has decreased by about 4/5 to only about 55 investors that actively make investments in India. Now, 2026 is on a recovery path. Till date, we've seen 62 individual unique investors that actually started investing again. Now, we still are far away from a recovery period just to reach numbers, for instance, also back in 2024, and we've seen 120 unique investors actually making investments into companies in India. So there's a long way to go. There's a bit of risk that we need to avert for investors to really make it better on the market overall. Now, when we look into India's, I call it Digital 2.0, is mostly about quality and integration. Now, I mentioned before, it's the second largest market when it comes to the volume of ventures. We have about 841 ventures that are headquartered in India that have raised overall cumulative funding of about $8.6 billion in the past 15 years. 56% of this money is actually floating into the top ventures, which is the top 10 companies, which ultimately tells you that the funding strength is very one-sided, directed into a single few companies. Overall, the average alpha score, which is our own proprietary maturity score, sits at 28% about, which is rather low. And I go into detail a bit later from now to really help you understand of how this actually comes about and what this actually means also for innovators who are trying to scale. If we put the 841 ventures into a global frame, that is about 5.2% of all companies that we're seeing. So even from a volume point of view, India is a very strong company, or it's a very strong market of where companies can expand into. We've seen that there are 4 implications. When we look into the 28 alpha score, this is not a verdict that the companies are weak, but there's a lot of breadth and depth that relates to mature markets. And we really need to focus on how can we enable some of the early ventures in order to scale significantly faster. When we look into the alpha score compared to the market size, we are seeing that there's a bit of discrepancy between maturity and where these companies are, but also the more ventures you have, obviously your average is generally being pulled down. Just if we look into a general weighting overall. So taking China and India as a comparison here, China with about 1,000 companies, so larger than the Indian market overall, has an average alpha score of 34 as compared to the 28 that we've seen within India. But when we look into smaller markets that are overall a bit more mature, so Korea and Japan as a comparison, we're seeing average alpha scores of 45 and 48 respectively. And this is generally driven by heavy governmental support that these companies are also receiving within the markets, and overall support to scale globally as well, to establish themselves. This is not necessarily that these companies are not investable when we see an overall score that is significantly low. And India definitely has enough scale to support specialist platforms. It's just missing a certain layer of evidence and regulatory credibility for many of these companies to establish long-lasting partnerships and business model durability, so that we can build a foundation where the capital can be deployed into. Now, when we look into where this funding is floating into, and even here we are seeing some of the correlation between funding and alpha score and why certain areas have been potentially overfunded but underdelivered. So looking just into online marketplaces and wellness overall, these two are generally very capital intensive. Now, they have a huge impact on the overall population, but in the late 2010s, there was probably a bit of, even early 2020s, there was a bit of too much capital concentration around B2C focused businesses, something that is generally very difficult to scale, as we probably all know, who have been working in healthcare for a very long time. So you do have a few companies or a few platforms that actually made this happen. 1MG being sold to Tata a few years ago, a few other companies that were actually public as well. But we have also seen many failures within it, and these are generally very capital heavy solutions that we are seeing. Scaling a wellness brand is not the easiest, neither is scaling an online marketplace, because it's a volume game and not so much a value game. Other areas that are generally underscaled and we've seen less funding into, but the average alpha score is significantly higher, are those as like medical diagnostic and research solutions, which is in line with the current scalability that we see also from a US point of view. If we take the 54% that I mentioned earlier of total capital being invested, we actually start seeing that there's a correlation also in other markets, including India, thus being a bit later. So we may see over the next few years that there's an uptick in medical diagnostics and research solutions, as especially generative AI solutions are also helping build evidence or do data interpretation significantly faster as before. There's middle layer of health insurtech, which is generally quite interesting, as we are seeing that companies are scaling in there. It is very mature, even within India, but overall very underfunded. When we look into where we see the capital is floating into, we generally have three metros: Bangalore, Mumbai, Delhi. We've seen that 62% of these companies are located within these markets, and 84% of the entire funding is actually deployed into. And then we have a few secondary hubs, Pune being very close to Mumbai as well, Chennai and Hyderabad obviously as well, considering that we see lots of innovation, especially around the IITs that we see. Now, when we look at the business models overall, there is a historical problem still within the Indian market, which is slowly but steadily changing. The majority of our companies in the beginning was very B2C centric, which, what I mentioned before, is very capital intensive, and you need to see a lot of investment actually floating into before you can see a return on your investment overall. Now, this has been now changing as well. So we see that there's more and more focusing towards HCPs and corporates overall, and we see it scaling. However, payer-centric solutions, so the ones who are actually paying for it, often from an insurance point of view, is still the major gap, which generally, to my knowledge and where I see lots of companies scaling into, is actually an interesting market to scale into, and it's easier to return your investment generally. This one I can skip over. When we look into some of the public rails, there is no equivalent in most markets, and this is why it is generally very under-indexed as compared to what I was previously mentioning. The scale first. So we've seen a lot of health accounts actually being now linked also to health records, and a lot of consultations are actually also being done through public rails within the Indian market. When we see some of the consequences that comes out of it is that they pull in the opposite direction. So the distribution that we are seeing within the market is where the friction falls. And we've seen compliance and integration bars are rising. We have DPDBs, concerns, cybersecurity and interoperability that is still failing, and it still needs a lot of work before this can scale even through the overall. And this is a transferable lesson. So I wear multiple hats even within Singapore, being an advisor to the government as well. And we've seen that a lot of things actually need to happen from a governmental point of view in order to support even digital solutions in order to scale, than just having them try to scale in a market where interoperability is not yet available. So when we look into where the value should accrue over the next 3 years, this is a Galen Growth point of view, is we have 4 pools, and each of them has a gate attached to it. And we're looking overall that we look into the payer and claims infrastructure overall. So we only have 37 ventures that are actually active in here. We look into AI and diagnostics and workflows. So 225 companies are actually actively employing AI first solutions. So I'm not looking into it's using AI somewhere, because then we probably have all companies at this point, but really AI first solutions. We look into longitudinal conditions and platforms overall. So everything that has to do with non-commutable diseases, diabetes, mental health, cardiovascular diseases overall, but also women's health that is overall scaling overall. And here we look into retention and care integration. And then we have the ABDM native infrastructures, the rails that make the interoperability and the distribution more advantageous overall. The gate here is generally the privacy and security standards that we have seen. Generally, India is not an emerging digital health market. It's a very scaled ecosystem, which has largely to do with before digital health, there was not much infrastructure. So there's actually an advantage overall in scaling this further. Now, when we look into the 4 pathways, I won't go into too much detail about these companies overall, but we saw 4 routes to scale. So there are Tata 1mg overall raised about $250 million before they were acquired in the end. MediBuddy, which looks into enterprise distribution, raised about $200 million. QAI raised about $170 million. And Wysa, which raised probably the least amount, has $30 million. Yet, when you actually look into the evidence scores of these companies, Wysa, one being the most underfunded companies, has actually a very high evidence score, meaning has returned a lot of scientific knowledge and scientific foundation to their solution, yet with only little funding deployed in it. So while the capital descends, it doesn't tell you necessarily what is the most defensible. Wysa here being the one that holds the highest evidence score overall, despite having the most funding overall, which is also the way of how the business model actually works. And it generally depends on the founders themselves, which pathway do they want to take? Is it more of the fulfillment, sponsored access, integration, or published evidence, so that you can establish yourself and build yourself a very profitable pathway? Capital raised should not be your proxy in terms of defensibility. Capital raise is often the fear of missing out and FOMO. And we often see that even companies that are raising billions of dollars are also failing. So funding shouldn't be your main concern for your company. So what does this actually mean for the people within the room? The bar has moved on, and this is what we should generally aim for. So when we look into founders, capital rewards generally proof and not just reach. And building evidence generation and workflow integration is one that we should be focusing on. Wysa did so, and so can many other companies as well. When we look into the investor landscape overall, 44% of all global funding went into research and diagnostics. It's still an underfunded area within India, so it's something that we can necessarily continue to focus on, while we are seeing that there's more innovation actually happening within the space as well. And we see many early stage companies also scaling within South Asia. We look into providers and payers. Now, this is a very underdeveloped market overall. So we only have 37 out of 841 ventures in India that actually focus on payers overall. There's a lot of room to breathe and the room to scale. And we just need to see how you can best scale in a market where some of the payer side is not the most clear path forward. The last one is the policy side. So public rails turned interoperability into distribution overall, and we need to treat standards, consent, and security as a competitive infrastructure. So ABDM is here the regional proof of concept overall. With this, I am finishing my discussion for today. I'm very open for this for questions. And Karthik did remind me that the All HealthTech folks are our India partner for HealthTech Alpha. If you have any interest in working with Galen Growth, with HealthTech Alpha, working with me, or working with Karthik's team, feel free to reach out to him. And looking forward to speaking with you further on. Thank you.
All right, thank you so much for that insightful keynote. Let's applaud for him. And thank you so much, Mr. Dario, for sharing your perspectives on health tech systems, the ecosystem, AI, and the opportunities that is going to shape the future of healthcare. That was a wonderful way to set the context for the conversation ahead. And if you have any questions, you can shoot your questions. Here's available right there. Anybody with any questions, we're going to hand over the mic to you. Okay, we have a person who has raised the hand there, a lady. Please pass on the mic.
Hello, Mr. Dario. It was an amazing speech. I'm Dr. Vashni here. I'm a founder and director of NeuroX Cognitive Solution, which is a neurotech startup. So now most of the startups are focused on the workflow automation, electronic medical records. For what is your one suggestion you would give for the startups which is focused on ailments, focusing on predictive and preventive care startups related to that? Because integrating such technology in the current workflow, we are finding it a little difficult. So what would be your suggestion for startups working on ailments and preventive and predictive care?
The audio.
Clients are generally hospitals, I imagine, correct?
Yes, hospitals.
Okay.
Yeah.
Hospitals. The problem that I see from a more macro point of view, and again, I'm wearing a few different hats, including also being an advisor to Singapore's largest public health cluster, SingHealth. The major issue that we generally see is when you scale a solution that taps into clinical data is generally the patient privacy. So some of the factors that we see that are causing issues also from a Singapore point of view is how do you protect patient privacy but at the same time utilize the data in a more research perspective, or at the same time being able to scale your solution. The problem we generally see is that every system utilizes different EHR systems, even in markets that are significantly more mature. So your solution needs to kind of stand out, that it becomes almost agnostic to the platform that you are working with. So FHIR adapters being one in this case, to look into how you can utilize only a limited set of data points to actually make a lasting impact. Now, most hospitals, and I also sit on the advisory side for a couple of hospitals where I'm assessing which solutions generally to generally work with, is the least friction of a hospital to work with an innovator is where you can demonstrate to a hospital that with the least amount of friction to the existing operations and therefore the interoperability with the hospital, you can, the easier it will be for a hospital to also partner with you. And you need to demonstrate your ROI for the hospital in a very short time frame. So we got 3 to 6 to 9 months generally, where you can demonstrate to them, okay, their there is the positive impact to the patients or to the hospital flow or to the clinicians overall. So your way in is very difficult, unfortunately, and you have a very short time to prove yourself in order to generate even an ROI for yourself, because a hospital is not necessarily willing to pay for a solution if they don't start seeing what's the impact overall. I'm not sure if this helps answer your question overall, but generally everything that is around ailments, you want to work with a hospital, it's a very hard nut to crack, I need to admit, and I've been on both sides, and you may have noticed it over the past few years. It's not the easiest, but it's a very important one.
Yeah. Thank you so much, sir. Thank you.
Thank you.
Thank you. Any other question? We have a gentleman who has raised the hand over there. Yes. Over to you, sir.
Hey, my name is Venkat, founder of Infograph Technologies. I just have one question, Dario. When it comes to AI, right? Yes, it's cut across all kind of sectors of the healthcare, but how the trust is established between the patient and the doctors, and how do you foresee the governance has to be put in place so that the maximum of AI is being reaped by the doctors and the patients? What is your view on? Of course, AI as a use case is fine, but how the trust and governance has to be put in place? Nice.
I kind of like that question. That's very good. So AI, and especially when we speak about large language models, which I think in this context at the moment is most of where the AI questions are floating into. Many of the solutions that I currently see that are more scalable is when we look into solutions that are not just your wrappers. So you're not recycling closed loop. So closed loop LLMs being your OpenAI, your Claude, and so on, whereby you are just chucking tokens towards something and you're hoping for an outcome. Most of the solutions that I currently start seeing that are scaling significantly better actually are sovereignly hosted models. So sovereignly hosted models being those that you can deploy on premise, that are tapping into data that are sitting also locally within where the solution is also being deployed. The advantage on this case, and again, here I can speak from a personal point of view, is you don't necessarily need to pass some of the privacy layers that especially hospitals, even government institutions are having, because you can demonstrate to them, I'm deploying it within your system. I'm only utilizing data that sits already within your system without any data being exported out from your servers. This generally increases a lot of trust when it comes to providers utilizing it. When we speak about solutions more on the diagnostics point of view, obviously you need to export data here. How it generally helps to tackle this is you are building out the additional trust layer. All of your data is fully auditable. You can demonstrate to your partner which data you have used in which capacity. So you are building towards a layer whereby you can demonstrate the trust that you are not misusing the data that you're actually using. And then the last bit, which is probably around the hallucination, especially when we now look into large language models again, is you need to build certain guardrails around it. Now, there are more and more guidelines that are provided now on a global scale as well of how you need to set a certain guardrail around it. So if you are adhering to some of these guidelines that are provided by, let's say, the FDA in the US that was published, I think, a month or two ago, if you adhere to this and you can demonstrate to this within your product demonstration as well, this generally increases, again, the chances of your solution being seen as something more superior or being something seen as being very, very trusted. So,
thank you.
All right. Well, I think we can conclude for this segment. We're going to move on to the next segment. And thank you so much once again, Dario, for connecting with all of us virtually and giving your time out for all of us. Once again, ladies and gentlemen, let's give a huge round of applause for Mr. Dario Heymann. Thank you. Thank you so much.